Welcome, my friends. Well, the continuing saga of the Credit Suisse slow-motion train wreck continues to unfold. A sale to UBS, which could be signed as early as this evening. The deal values Credit Suisse at around $7 billion less than its market value at Friday's close. It comes after Credit Suisse shares logged their worst weekly decline since the onset of the coronavirus pandemic. This despite an announcement that it would access a loan of up to 50 billion Swiss francs, $54 billion, from the Swiss central bank. Most people tend to forget, but Credit Suisse has basically careened from one disaster to another. But this most recent crisis might be too much for the Swiss banking giant to overcome. Not to mention, the world might be better off without Credit Suisse. What does it mean for the economy? And what does it mean for the future of the United States? But before we get into all of that, please press the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. According to the Financial Times, UBS offers to buy Credit Suisse for up to $1 billion. Swiss banking giant UBS on Sunday offered to buy its embattled rival Credit Suisse. According to the Financial Times, the deal would value Credit Suisse at about $1 billion. The deal, which the FT said could be signed as early as Sunday evening. And it values Credit Suisse at around $7 billion less than its market value at Friday's close. The FT said UBS had offered a price of 0.25 Swiss francs, 27 cents, a share to be paid in UBS stock. Credit Suisse shares ended Friday at 1.86 Swiss francs. The fast-moving nature of the negotiations means the terms of any end deal could be different from those reported. Credit Suisse is reportedly balking at the offer. Credit Suisse claims that the offer is too low and would hurt shareholders and employees. Credit Suisse and UBS declined to comment on the reports. Swiss authorities are also reportedly considering full or partial nationalization of the Credit Suisse. That would be an alternative to the UBS takeover by another bank. The UBS deal is being orchestrated quickly. So, the Swiss are preparing for the case that it falls through. Switzerland is reportedly considering whether it would take over the bank completely, or hold a significant equity stake. The UBS offer comes after Credit Suisse shares logged their worst weekly decline since the onset of the coronavirus pandemic. This is despite an announcement that it would access a loan of up to 50 billion Swiss francs, $54 billion, from the Swiss central bank. It had already been battling a string of losses and scandals. And last week's sentiment was rocked again with the collapse of Silicon Valley Bank. And the shuttering of Signature Bank in the US, sending shares sliding. Credit Suisse's scale and potential impact on the global economy is much greater than the US banks. The Swiss bank's balance sheet is around twice the size of Lehman Brothers when it collapsed. Its total balance sheet is around 530 billion Swiss francs as of end 2022. It is also far more globally interconnected, with multiple international subsidiaries. This makes an orderly management of Credit Suisse's situation even more important. Credit Suisse lost around 38% of its deposits in the fourth quarter of 2022. It also revealed in its delayed annual report early last week that outflows have still yet to reverse. It reported a full-year net loss of 7.3 billion Swiss francs for 2022 and expects a further, substantial, loss in 2023. The bank had previously announced a massive strategic overhaul. This was a bid to address these chronic issues, with current CEO and Credit Suisse veteran Ulrich Körner taking over in July. For those of you unfamiliar, Credit Suisse has a long history of corruption and scandals. Credit Suisse is a Switzerland-based multinational investment bank and financial services company. Over the years, Credit Suisse has faced a number of corruption scandals that have tarnished its reputation and led to legal and financial repercussions. One of the most prominent corruption scandals involving Credit Suisse occurred in 2014. At that time, the bank pleaded guilty to helping Americans evade taxes. Credit Suisse admitted to facilitating tax evasion by setting up sham accounts and transferring money to offshore tax havens. The bank agreed to pay $2.6 billion in fines and penalties to U.S. authorities. In 2016, Credit Suisse was embroiled in another corruption scandal, this time involving the 1MDB scandal. The 1MDB was a Malaysian state fund that was set up to promote economic development, but it was used to siphon off billions of dollars for personal gain. Credit Suisse was one of several banks that were found to have helped facilitate the corruption by providing loans and other financial services. Credit Suisse was fined $47 million by Swiss regulators in connection with the scandal. More recently, in 2021, Credit Suisse was hit by a scandal involving the collapse of the hedge fund, Archegos Capital Management. Credit Suisse was one of several banks that provided financing to Archegos. But the hedge fund's risky bets on stocks led to massive losses. Credit Suisse was forced to take a $4.7 billion hit as a result of the scandal and suffered reputational damage. In addition to these scandals, Credit Suisse has also faced criticism for its involvement in controversial transactions, including those related to fossil fuel projects, arms trading, and human rights abuses. These issues have raised questions about the bank's commitment to ethical and sustainable practices. And financial regulators have closed Silicon Valley Bank and taken control of its deposits. The FDIC said in the announcement that insured depositors will have access to their money. The FDIC's standard insurance covers up to $250,000 per depositor, per bank, for each account ownership category. As of the end of December, Silicon Valley Bank had roughly $209 billion in total assets and $175.4 billion in total deposits, according to the press release. Silicon Valley Bank was a major bank for venture-backed companies, which were already under pressure due to higher interest rates and slowdown for initial public offerings. The FDIC said loan customers of Silicon Valley Bank should continue to make their payments as normal. The move represents a rapid downfall for Silicon Valley Bank. On Wednesday, the bank announced that it was looking to raise more than $2 billion in additional capital. That comes after suffering a $1.8 billion loss on asset sales. Then, they dropped another 60% in pre-market trading on Friday before being halted. However, a rapid outflow of deposits was complicating the sales process. There seems to be a lot of financial turmoil in Silicon Valley these days. If you recall, it was just a year ago when SPACs were all the rage. SPACs are also known as blank check companies. They typically have no operations or revenue at the time of their IPO. Instead, they raise funds from investors through the sale of units. This typically consists of one share of common stock and a fraction of a warrant to purchase additional shares at a later date. The funds raised from the IPO are held in a trust. That continues until the SPAC identifies a target company to merge with or acquire. Once a suitable target is identified, the SPAC will negotiate the terms of the merger or acquisition. The next step is for the SPAC and the target company will merge or be acquired. At that point, the combined entity will become a publicly traded company. Some might have called it a SPAC fad. Not all SPACs are successful in doing what they set out to do. Some SPACs may struggle to find a target company to merge with or acquire. The Great SPAC crash basically ended 2022 in dramatic fashion. December witnessed a record flurry of liquidations. And if you follow this channel, you know that the Federal Reserve is aggressively raising interest rates. And it is hindering the industry's ability to get deals done. That means that firms are left with far less money than they initially expected. Meanwhile, there is a new tax threat. It is all part of President Biden's sweeping tax, climate and health legislation. The new law has pushed dozens of blank check sponsors to liquidate early. Share buybacks are a key move that public companies use to help boost their value. Many companies would rather invest the extra revenue in the business or paying higher dividends. Other types of shares, such as preferred stock with built-in redemption features, also appear to have been hit by the new law, which goes into effect in 2023. And things could get even worse. More than 50 SPACs with almost $15 billion in cash. And, if you follow this channel, you probably already know that tech companies are sensing weak macroeconomic conditions. Inflation is raging in most parts of the world. Central banks are aggressively raising interest rates in order to tame inflation. Consumers' budgets are getting tighter because of having to spend more on gas and food. So, consumer discretionary spending is weakening. Layoffs at big tech companies are big news because the biggest tech companies went on a veritable hiring spree throughout the pandemic. But the United States is now teetering on the brink of recession and the digital ad market has plunged. But, what do you think? Please leave us a comment below and hit the like button. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.